So today's topic is accounting for internal reconstruction. The subtopics are reconstruction, meaning, need, methods of reconstruction, internal reconstruction and external reconstruction. Once we know what internal reconstruction implies, then we will move on to understanding scheme of internal reconstruction. After this, the process of accounting, which is the main part of this chapter, accounting for internal reconstruction starts, which includes 5 subtopics: alteration of share capital, change in shareholders' rights, reduction of share capital, then compromise and arrangement through sacrifice or surrender of shares, and finally utilization of reconstruction account or the resources generated from all this above for the adjusting values of assets and claims of liabilities and to write off the losses. Now, when we are accounting for internal reconstruction, it basically implies that in the process of accounting, we have 5 steps involved, whereas at this time, in the 4th step, we have 2 options available: sacrifice or surrender of shares. So, the accounting of internal reconstruction will be studied in 2 methods: through sacrifice of shares or claims, and secondly through surrender of shares by the shareholders. Now, taking up each of the topics one by one. The very first thing is what is meant by reconstruction and why do we need this? Why is there a need for reconstruction of any company? So, consider reconstruction basically implies restructuring of a company. That is, we are reorganizing the structure, financial structure of the company. So it involves complete overhauling of the financial position of a company, covering all assets, liabilities and capital. That is equity and preference. So the objectives are to give true and fair view of the financial position of a company and to improve profitability of the company in relation to the true assets. That is, in case of reconstruction, the overall financial structure of the company is to be reorganized. Like when we say financial structure, it implies assets, liabilities, owner's capital. So this financial structure is to be reorganized. You are to adjust the values of assets, claims of liabilities and the owners, that is the shareholders, in such a manner that the new position, adjusted financial position, gives us true and fair view of the working or the position of the company. And when we show the assets and liabilities at their true value, it means the profitability of the company will improve in relation to its true assets. Are you understanding? So, if you have a company's overinflated assets, net assets of 50 lakh rupees and it is earning 50,000 rupees of profit. So, we can say it is 1% of the assets. However, if we find that the assets are overvalued and actually the assets of the company are not 50 lakhs, they are just 10 lakh. Now, on that 10 lakh, the same earning of 50,000 now amounts to 5%. So, it improves profitability by showing the true assets of the company. Now, question arises, why is there a need for reorganizing or restructuring the financial position? Because in any case, a company is having an asset and liability position being shown over the years through its accounting procedures. So, why is there a need? Basically, the need arises for sick companies. That is, the companies which are not working properly, which are sick, which are having continuous losses over a long period of time in the past, and they are not able to recover from that. So they now want to change the position. They want to have a correct picture of the company to be shown so that they can work on that and then improve their working. So sick companies are those companies wherein they have a lot of overvalued assets. Like when a company is running into losses, then it tries to overestimate its assets. It tries to keep the losses secret. So if your asset is, say, subject to 20% depreciation, but now because you do not have profits, so you want to charge lesser depreciation. You know that most of your debtors have become bad, but you are not bringing them into picture. You have got goodwill, patents, copyrights, their value has expired, but still you are showing them because you want to show good assets to the public. So the assets of such companies are usually overvalued, and they are filled with intangibles like goodwill, patents, copyrights, which are valueless. They have more of accumulated expenses. Their debtors are not fully recoverable. Their inventories are all outdated. So they are not having their assets being represented at their true value. Then they have overdue outside liabilities. Their liabilities are overdue. They are to pay the liabilities, but since they do not have enough of assets, they are not able to pay liabilities. They have inflated capital. Now in case of companies, the capital is kept separate and reserve and surplus accounts are kept separate. Unlike sole proprietorship, wherein the moment you have a loss, your capital reduces. So in these companies, their losses are accumulating. So their capital has been lost, but still they are showing the total capital. So the net result is that in case of sick companies, the financial statement do not give true and fair view of the state of affairs of company. Like take the case of this company. Its company's balance sheet. Shareholders' capital is 2 lakh. They have surplus negative 60,000. They have debentures as a liability. Creditors, they have provision for tax. Now when we look at assets, they have tangible assets, building and machinery. Goodwill 40,000. Apart from current assets, they have preliminary expenses. So a major chunk of their assets is in form of intangibles and expenses, and they have losses, accumulated losses over a period of time. Further, a thorough analysis tells us that their interest on debentures is also pending. Their liability is settled at 15,000. They are still showing it at 4,000. So again, if they bring this liability into the accounting, their surplus will be reduced further. So they will be having more of losses. Machinery is overvalued. Building's value is 52,000. So their assets are overvalued. So this total of assets is overvalued. Their assets are much, much lesser. On the other side, their liabilities are higher and their capital is lost. So such companies need restructuring. They need to show their assets at their true worth, their liabilities at their actual claims. Now this overhauling or restructuring is done through two means: internal reconstruction and external reconstruction. Now in case of internal reconstruction, the reorganization of the financial position is done internally. That is within the company, within same company, the board as well as the shareholders, they join together and think of the ways to cancel the losses and to bring assets and liabilities at their true value. So they make an estimate that this is a loss which we are to cancel. We are to write off this. We are to write off overvaluation of these assets. We are to bring liabilities into picture. So they try to measure how much is the total loss and who will bear this loss. If they can ask their liability holders and convince them to at least sacrifice some amount so that the loss burden is reduced, then remaining burden is borne by the shareholders. So after all the adjustments in the same balance sheet within the same company, they will be in a position to show assets not at this value but at the true value, liabilities at their actual value. So internal restructuring or internal reconstruction implies that reorganizing the financial position of the company internally within the set company. External reconstruction. It involves reorganization of the company by liquidating existing sick company and forming a new company to take over its assets, liabilities and continue the business. So in external reconstruction, what is happening is that the present company, which is a sick company, it goes into liquidation. So it sells all its assets and liabilities to the newly formed company, which is formed to acquire this company. So there is a new company which is being formed, which will take over this company, including its assets and liabilities at their true claims, and it will continue their business. So this is done externally. because this is not happening within the books. This company goes into liquidation, you close all its books, it is sold off, a new company enters the picture. Now that new company will buy its assets, pay off its liabilities or take over the liabilities, and after adjusting all the losses, whatever balance is left will be given to the shareholders in form of shares in the new company. If somebody doesn't agree with the scheme, they might be paid off. So external reconstruction implies sale of old company and purchase of this company by a newly established company. So internal and external reconstruction are different in the sense that number one, the concept is different. Concept is that in internal reconstruction, the restructuring is done internally. So within the same company's books, values change. External reconstruction implies a new company is formed to take over existing company. So, second point of distinction is liquidation. Does it involve liquidation? Nothing. Internal reconstruction is done internally, no liquidation. But yes, in external reconstruction, existing company goes into liquidation. There is no formation of a new company here. However, in external reconstruction, again, yes, a new company is formed with the objective of buying the existing company. So, same business is being continued by the same existing company in internal reconstruction, whereas in external reconstruction, the new company takes over the business of old company. Now, next is the mode or the share capital adjustment. So, in internal reconstruction, share capital is adjusted through reduction, sacrifice, surrender. So your existing shareholders, they sacrifice a part of their capital, they surrender a part of their capital claims, or their capital goes into restructuring in the form of subdivision of shares, consolidation of shares. Whereas in external reconstruction, nothing of this sort happens, but the shareholders of existing company gets shares in the new company against the purchase consideration. So the legal position is that in internal reconstruction, same company continues and it restructures its position and it files a new balance sheet which is called balance sheet and reduced. They need to add this phrase and reduced with their balance sheet to show that this is the balance sheet of the company after internal reconstruction. Whereas in external reconstruction, the legal position is that old company or existing company goes out and a new company is formed. So, new company starts. So, with the assets and liabilities of the old existing company, a new company starts. So, this is how we distinguish between internal and external reconstruction. So, by now you are clear that in internal reconstruction, which is our main topic, we will be working for the restructuring of the company internally. We will be having a balance sheet of a company like this, which is filled with the losses and overvalued assets and understated liabilities. And now the company will be adjusting its assets and liabilities. So in order to adjust the assets and liabilities, the company thinks of a scheme of reorganization, whereby they measure the losses and then they try to see how to take up the gains or sacrifices to account for the losses or to adjust the losses. So the way in which this entire procedure takes place is called a scheme of internal reconstruction. Although in our course we are not to see how this scheme is framed, but we still need to know what this scheme actually means. Because once we know what is included in the scheme, we are in a position to account for the transactions, because we are to identify the transactions and record them for the internal reconstruction. So in the coming video, we will be understanding scheme of internal reconstruction. So we have done reconstruction, meaning and need, methods of reconstruction, difference of the two. So next time we will be taking up the third topic,